Welcome to the Mortgage Foundations podcast, where we are here to guide you through the ins and outs of the mortgage world. Get ready to unravel the complexities and gain a solid understanding of everything you need to know about mortgages. Whether you're a first-time homebuyer or a seasoned homeowner, we've got you covered with expert insights and tips. Let's dive into the fascinating world of mortgages together. In today's episode, Tyler Cowell, the principal broker of Mortgage Foundations, FSRA number 13614, will discuss debt consolidation mortgages and how they can be used to save money on interest and help your monthly cash flow. Also, stay tuned at the end to hear one of Tyler's dad jokes.
High-interest debt from credit cards or loans can make it hard to efficiently manage your finances and can lead to falling behind on payments. Even minimum payments can be tough to make when debt gets out of control. If you have the equity available in your home, a debt consolidation mortgage may be able to help. A debt consolidation mortgage is a type of refinance that combines two or more liabilities into one mortgage or a home equity line of credit, or HELOC. The reason that this could be a great option to help pay down debt is that once all the liabilities are paid off, you are left with one payment rather than multiple payments. It can be easier to manage the one payment than cover a bunch of payments that seem to keep growing over time. Another benefit of using a debt consolidation mortgage is that the interest rate will likely be much less than the rate being charged on credit cards and loans. It is common to see credit card interest rates above 20% versus a mortgage or HELOC rate that will likely be considerably less. The lower interest rate will assist in being able to get ahead of your debt, since less of your monthly payments will be going to pay interest, and seeing balances grow month by month may be eliminated. It is important to mention that before entering into a debt consolidation mortgage, a budget should be prepared to ensure that the debt consolidation mortgage will put you into a better position. Even though this is usually the case, a calculated and detailed budget can provide evidence of the better position. While going through the budget and liabilities, it is also important to review interest rates on existing liabilities to ensure that they are not less than the planned mortgage or HELOC rate. Unless the lender required it, there wouldn't be much sense in paying out a low-interest car loan with a mortgage that may feature a higher rate. While reviewing the budget and mortgage options, it is also important to consider if the debt consolidation mortgage should be used for any existing mortgages on your property, or if it is better to leave the existing mortgage in place and use a HELOC or second mortgage to consolidate the debt. Much like using a debt consolidation mortgage to pay out a low-interest car loan, it likely wouldn't make sense to pay out a mortgage with a low rate or incur a large penalty to break the current mortgage. The potential higher rate on the mortgage or penalties may erase any potential savings from the debt consolidation. Since debt consolidation scenarios can be wide-ranging and there are many moving parts to them, especially when loans and mortgages are involved, I will focus my example on consolidating credit card debts and a personal line of credit into a home equity line of credit. This basic example will show the cash flow and interest savings that can be found by moving multiple high-interest debts into one liability and monthly payment. Let's say that clients have total credit card debt of $40,000 at 20.99%, with a combined minimum monthly payment of $1,200, and a personal line of credit of $20,000 at 12%, with a minimum monthly payment of $300. The monthly interest cost on these debts would be roughly $900, and the combined minimum monthly payments would be $1,500. By consolidating these debts into a $60,000 home equity line of credit, we can not only reduce the monthly payment and increase cash flow, but we can also save a substantial amount of interest expense. For the purposes of this example, I will use a home equity line of credit rate of prime plus 4%. However, it should be noted that depending who your mortgage is with, a HELOC may feature a rate in the neighborhood of prime plus 1%. As of the time of writing this podcast, prime is currently 6.45%, which means our example is going to use a rate of 10.45%, which is not far off of the personal loan interest rate, but is much lower than the rate on the higher balance credit cards. Using the interest rate of 10.45% for the home equity line of credit, the monthly interest cost would be $523, and the minimum monthly payment would be lender-specific and would need to cover at least the interest and some principal. Let's say, for example, the minimum monthly payment is $623. Using this example, we have an interest savings of $377 per month, or $4,524 per year, and extra cash flow of $877 per month. As mentioned previously, it is important to ensure that a debt consolidation mortgage is the right solution and will actually put you in a better financial position. A mortgage broker will be able to calculate your savings and assist with building a budget to make sure that the planned debt consolidation solution is in your best interests when presenting all the benefits and drawbacks. A full review will also indicate which debts should be included and which debts may be able to be left in place in order to maximize your savings. In conclusion, a debt consolidation mortgage is basically a mortgage refinance or the addition of a home equity line of credit or additional mortgage. The funds advanced from the lender are used to pay out higher interest debts and consolidate them all into one lower payment with less interest expense. It is important to review your options with a mortgage broker to see if it is the right solution for you and find out how much you can potentially save by consolidating your debt.
In today's episode, we explained how a debt consolidation mortgage works and how it may be able to save you money and put you in a better financial position. Thank you for tuning in to Mortgage Foundations. And remember, every home starts with a foundation. Your mortgage should too.
Time for this week's dad joke, which I may have used once or a few hundred times myself. Pinocchio hasn't had much luck on dating sites lately. But what do you expect from a guy who is looking for a relationship with no strings attached?